Welcome back, everyone. I hope you had a nice break. Our next panel, really excited about this one. So it's going to be about ETF liquidity. And basically, we're going to be looking at how basically bond ETFs behave during periods of market stress. Obviously, the wide discounts seen in March were a big talking point back then. And now the dust has settled, we can take a proper look into this. We've got three fantastic speakers: Adriano Pace, Head of Equities Europe at TradeWeb; Daniel Izzo, CEO of GHCO; and Alan Moreira, Associate Professor of Finance at the University of Rochester. Just before we begin, a reminder to get your questions in to the panelists and do take part in the poll as well. Adriano, just coming to you first, do you think you could paint the picture for us and just talk about what happened during the March volatility to ETFs?
Good afternoon, everyone, and pleasure to be on this panel. So the March-April period for us was a particularly busy one. Just to put it into context, on ETFs, in the run-up to March, we were averaging around about 1.5, 1.6 billion euros a day, and pretty much from the off, as soon as market conditions deteriorated, we saw over a doubling of the notionals that were executing on our platform, and then within that, the proportion of fixed income ETFs grew within the total. So historically, fixed income ETFs are around about 35% of our ETF platform activity. We saw peaks of around about 40 to 50% of activity in that period. So from a volume point of view, very good news. I guess, to counterbalance that, it is worth saying that, maybe it was because we were dealing with working from home conditions for a lot of people at the same time. There was a deterioration in liquidity in some areas. So certainly with fixed income ETFs, credit ETFs, we saw probably an over-reliance on a smaller pool of liquidity providers compared to usual. So some of that, I'm sure, was down to capital being reined in at some of the firms. Others, it was just a dislocation from working away from the offices. But we did notice an over-reliance on primarily two or three liquidity providers, which clearly we wouldn't see in normal conditions. I think conditions have since stabilized from that point of view, and that's good to see. Final point, and I'm sure we'll cover this in this panel. It was noticeable that bid-offer spreads widened as a result, and the best way we could quantify that is through the NAV RFQs that we were seeing. So as a reminder, the way that institutional clients traditionally send RFQs is either on risk or via NAV. And with NAVs, we could very clearly spot some significant discounts compared to what we were used to seeing. So in basis points, triple digit decreases versus the official NAVs. Not only that, but we saw a wider dispersion in the quotes that we were receiving. So, normally they're bunched in fairly closely together. There we were seeing a much wider environment between one liquidity provider and another. Again, since then, markets have certainly normalized, but in that pocket, we were seeing that behavior.
The wide discounts certainly sort of captured the headlines. Do you think Adriano, you could explain a little bit about why bond ETFs did widen to such discounts and what exactly was going on there?
Yeah, so and I'm sure the other panelists will comment as well. We are of a very clear opinion on this one. If you think of what the NAV is trying to reflect, it's trying to reflect what the basket of underlying cash securities are indicating. So whether it's a stock or a bond ETF, it's essentially the valuation of the benchmark inside of the ETF. And I guess in a normalized environment, that should center around NAV. In a falling market like we saw in March, April, we saw that those discounts increase. But we are very strongly of the opinion that when you look at the volumes executed, and again, as I mentioned earlier, they were very significant, the ETF as a tradable instrument is the reference point for price discovery. The problem really sits with the way that these NAVs are calculated, whether it's because the underlying bonds are not trading or whether they're not really fully reflecting the risk premium that should be embedded in them is a topic for discussion. Certainly the analysis that we've done since then would indicate that the whoever is providing the NAVs in these funds wasn't fully accounting for the fact that if you're an approved participant that is showing a bid price in an ETF, and it hence goes long the ETF and has to try and sell the underlying bonds, the NAV was certainly not fully reflecting the price where genuinely you would have been able to sell the bonds. And so the APs were doing the right job. They were basically factoring in, how difficult it would be to sell the bonds, how long a holding period would need to be able to offload those positions. And the ETF was probably the best reference point. The NAVs are probably subject to improvement over time. That would be obvious.
Yeah, that's really interesting. Dan, is this what you were kind of seeing?
Yeah, very much so. I'd definitely like to echo what Adriano said, which is the ETFs were the most accurately priced security in this conversation, right? Which is to say that the NAV was not a fair representation of what was achievable. So when we look at the NAV and we take delivery of the bonds, the NAV is marking either through third party or through the primary custodian at off of a set of rules. For a lot of the ETFs, the rule is, well, what is the last traded price, or what's the closing price, or an implied closing price, which means that when these bonds stop trading, which is exactly what happens, the price that's used in the NAV calculation becomes stale. And so the NAV that you may see and that people measure this alleged premium or discount against is not actual. It's not achievable through the arbitrage. In fact, very rarely is it fully accurate. The best examples that we can give is, well, oftentimes what you see is if you trade volume at discount, at the appropriate discount with the prices that we're putting into market, and we execute the redemption the next day, because we force the bonds to trade and update the marks, the new NAV the following day is right in line with the market price that we traded the ETF at. Now, there's no disputing that discounts did increase during the sell-off. But that is not an arbitrary thing. That discount is calculated to the nth degree to reflect what we think the risk premium is. And that risk premium, as Adriano pointed out, is driven by how long is it going to take us to clear the inventory? What's the cost of the balance sheet that we use to hold that inventory? And what's an actual achievable price in the bonds? That the achievable price in the bonds is by far the least determined number. And so we price for that risk.
And, Adriano mentioned liquidity providers were slightly stretched during this period. How stretched were you, and as a market maker in that sort of volatility?
So we particularly were not that stretched, mostly because of our positioning prior to the risk environment. And so that was fortunate for us, and we were able to maintain our presence to the full extent. That being said, I know very clearly what went on with my competitors, because we generally all clear the same prime brokers. And what effectively happened was the risk premium that our PBs were charging went up dramatically with the implied additional risk of the inventories. And so what you got was an effective tightening of credit, which we then had to price into the ETFs. Now, why the tightening of credit matters is as we accumulate inventory, and we have to account for the holding period of the inventory, there's opportunity cost. And there, for certain, were situations in the spring when it came down to, are we going to be tying up significant portions of our balance sheet on inventories that will not clear until after the crisis passes? There are some esoteric bond products that we were not able to find any resemblance of a bid in the underlying bonds, right? Even though we're willing to sell at a significant discount to the last mark in the bond, and we're a relatively unique participant in the bond market, in the primary market for the bonds that way, we couldn't find a bidder at all. And so the assumption becomes, all right, we're going to carry this until a normalized market environment returns. And what's the cost of that? Because when the balance sheet gets full, I can't even send a quote anymore, right? And that's a single point of failure that is never allowable for us because of our commitment to the ETF issuers to always be there with a bid. And so we have to plan for that.
Yeah, and just for some people some watching, do you think you could slightly explain the role of the market maker, because it does carry a bit of a mystique in this industry? So
sure. So there's two facets of market making primarily. One is the on-screen price, which is what GHCO does very well, and we have been persistent at for a number of years. Which is so that when you go to trade your bond ETF, any kind of ETF, there's always a price. There's always a bid and an offer, and if you want to sell, you can sell. The secondary role, which is where you see the vast majority of volume in the market, is through vendors like TradeWeb, Bloomberg, to name another, but what will very soon also include the LSE and the SIX Swiss, which is the RFQ model, which is something that GHCO has had very limited participation in the past. That's effectively the liquidity venue where you generate your OTC trade. We try to keep those prices directly in line with what's on the screen, so that what you see on screen, even if you don't trade it on screen, is an achievable price in the risk market. I hope that answered the question.
Right. Yeah. Perfect. Just coming to you now, Alan. You've done some great research on this around liquidity and what actually happened during the March volatility. Do you think you could kind of explain what your research has been?
Right.
Yeah.
So thank you for having me in this panel. So I think to think about how well or how bad ETFs did in basically the most acute phase of the COVID-19 crisis, which happened back in March before the Fed pulled out all the stops in March 23. It is important to understand what happened in corporate bond markets, right? So the typical relationship between kind of the stock market and the corporate bond market would have predicted a drop on investment grade of about 5% in March, right? Instead, we got a 20% drop, with investment grade dropping as much as high yield, right? So some very severe dislocations happening in corporate bond market. So the sharp drop was particularly severe on the very safe and short-term piece of IG. For example, we had like Google 6-year bonds with spreads going up from 30 basis to 200 basis points with a lot of trading, okay? With the CDS barely moving, right? Now, this behavior was typical what happened with IG more broadly, right? So you see that the CDS bond basis, that is the wedge between what's the price of credit risk in the corporate bond market in CDS, open up, right? And most of the movement in spreads was just basis, right? Telling us there was very severe dislocations happening there, okay? So that's the starting point, okay? That's nothing to do with ETFs, but we know there's something very big happening in corporate bond markets, in particular investment grade. Now, turning to ETFs, we saw this 20% drop in prices. And of this 20%, 5% was at the bottom was discount, okay? It was basically the gap between NAV and ETF price. So about 25% of the overall price movement. If you focus on short-term ETFs, the discount was 50% of the overall price movement. So very, very substantial discounts relative to the overall price movements. Now, where is this NAV reals or just stale? And I think there's some discussion here, and some of the explanations that Danielle gives suggest that those are real when they come with like arbitrageurs being constrained, and others suggest they were not as real because of some staleness on the NAV. So just to have a sense, it's good to focus the mind on some examples. For example, Vanguard has funds that you can own the same basket either through mutual fund structure or corporate or ETF structure, right? So in March 20, you could have sold the mutual fund structure at a 6% drop and bought the ETF structure at a 12% drop, right? Doing a round trip trade of like 6% that a retail investor, could do, right? So those were very real that people, not only specialists could have done this trade. They would need a long position on mutual funds, obviously. We saw lots of arbitrage activity redeeming ETFs and selling the bonds. So the APs, the authorized participants, the market makers, were doing this activity, suggesting that these NAVs were not just nuts. There was something there because they were doing this arbitrage activity. For example, if you focus on the flagship LQD ETF, that's the biggest corporate bond ETF in investment grade, dealers did about 10% of outstanding of this activity, okay, or APs. So if you look in treasuries, there it's interesting because the market went up. So you see that their net asset values actually moved by more than the ETF. You still have the discount with a more liquid instrument trading below, but it's not the issue of staleness. Actually, the NAV is moving by more, right? Again, suggesting that there's something real about these movements. High yield, even though they moved a lot, you have no discounts there. It's just wigging around zero, right? So there's something special about investment grade dislocation. And so this suggests that at least some of it are real, and maybe because arbitrageurs were constrained and had concerns about the ability of making markets in the future, as Daniel suggested. But it's important to think, then you can say, well, ETFs did poorly. But it's important to relative to what, right? Relative to mutual funds, it did significantly better, right? Because the ETF structure allows non-specialists to provide liquidity to sellers, right? Because anybody, they see this discount, they can go and buy. It's a long position, it's not an arbitrage, but you can step in. The price of liquidity is fluctuating and allows the system to stabilize itself, right? In mutual funds, you must rely exclusively on liquidity of the underlying market. That is, if there's a lot of outflows from mutual funds, they have to find buyers for these particular corporate bonds. And that's a problem. Why is that a problem? For example, you saw this massive surge in trading volumes of ETFs, during the collapse of prices, dollar volumes went up by 200%, while trading volumes on corporate bond markets didn't change, right? They stayed flat at about $100 billion a week. And then you can see if you are an instrument like mutual funds, that to satisfy outflows, you need to trade on the underlying, that's going to be a problem. While the ETF, it relies some of trading on the underlying through the APs that are, but also brings liquidity provision from the outside, what we call in academic outside liquidity. And how it does that? By letting these premiums move around. And so the fact that these premiums move around is actually a great thing for the ETF instrument. We might not like it, but sometimes liquidity is scarce, and that's certainly what we saw in March. So that's
That's really interesting. Adriano, we just had a question from the audience. Could there be another event where we see discounts reach such highs, or is this a very rare occurrence?
It's a good question. So I would say we hadn't observed discounts of that magnitude before by any stretch of the imagination. We had seen a number of fast markets, and actually it's worth pointing out, like when the Fed did step in, we did see some premiums coming in. So corroborating our version of events, which is the NAV is stale. It can work both ways. So that's one thing to point out. The other, which I think is relevant, and maybe here we're stretching out into the future a little bit, but one clear observation from our side is the advent of portfolio trading in fixed income. So if I take you through that very quickly, we started seeing the advent of portfolio trading in the US a couple of years ago. It expanded into Europe 6 to 12 months later. And we're seeing a very clear trend in institutional clients packaging a list of cash bonds that they then require quoting on in a contingent manner. Now, why is that important? It's important because depending on what that basket includes, it can lead to an improvement in execution of the bonds, but also it starts to converge the cash bond market with the ETF market, which frankly, if you think of an ETF as a basket of bonds, you can see that conversion occurring. So what we've noticed already in the first 1 or 2 years of increased activity in portfolio trading is that the more this contingent list of bonds reflects a slice of the fixed income market. So it could be a particular part of the yield curve, or it could be a broad selection of sectors within that basket. The more appetite there is from the bond liquidity providers to essentially look at that not as the idiosyncratic risk of every bond inside it, but more as like a beta play on a particular part of the market. So if someone happens to come in with a 100-item basket and it's all buys and it happens to be well spread across multiple sectors, we're seeing an increased appetite to quote on those in significant sizes. And the people quoting, and this is the second interesting part, and not just traditional investment banks, fixed income divisions, but it's now the ETF specialist desks within those banks, as well as some of the liquidity providers, some of the ELPs and market makers who've always been very active in ETFs. They're starting to become more and more able to rapidly price these portfolios. And why is that? Well, for a simple reason that if they get their hands on 100 items and there's only a little bit left over to turn it into a creation basket, they can literally hand it over to the ETF issuer, and they no longer have to hold that inventory. That's worth pointing out. But again, that's probably projecting forward. Could it happen again, like in March, April? If the NAVs remain stale, it could happen again. But I would say, looking back over the last 8 years, it's the only time we've seen it to that extent.
If I can, Tom.
Yes, definitely.
I just wanted to step in there because I think having been through the fixed income ETF evolution in the US and seen it from both sides, I'm very optimistic that what we're doing in fixed income ETFs as market participants is actually going to evolve the primary market of fixed income, right? ETFs are now creating liquidity in the bonds because of the function of the arbitrage and because of the function of the APs and market makers. We are not the traditional bond trader. The traditional bond trader in the industry status quo, when there's a crisis, and I have been through at least 3 with material discounts, like we saw, the status quo from the bond industry is to just duck and cover and wait for it to pass. And that's exactly why you see the stale NAV, which is, they're living under the illusion of if there's no trade in the bond, then it hasn't gone down, which just quite frankly isn't possible, right?
Yeah, exactly.
And so to Adriano's point, if we can find liquidity or provide liquidity in the bonds themselves, it rapidly reduces that perception of discount, because the single biggest thing that's going to eliminate this conception of a discount in moments of crisis is rapidly updating the bond pricing. And the more liquidity that there is in the bonds themselves, the more accurately we can price. We don't operate in a vacuum. I don't need to name who my competitors are, but they are exceptional and exceptionally talented and capable. So there's no environment where I can stand to send a wide price to the market and think that I'm going to get any of that flow. We are constantly competing with one another to capture the flow, and we do that by providing the best price. And you have to allow that competitive market to really drive price efficiency, which is what we all should want. We should want efficient pricing of the ETFs, and that can only be done with legitimate bond liquidity. And I'm really proud to be part of the ETF industry and forcing that evolution in fixed income, because this nonsense of, well, I'm not going to mark my mutual fund down because the bonds haven't traded, even though the CDX has an implied discount of 20%, is, I mean, it's a fraud. So yeah, I hope that with each passing crisis, we trade more ETF liquidity and thereby force more liquidity into the bond market. And we'll see how long the mutual funds last.
Fighting talk. Adriano, if the bond market is playing catch up with ETFs just due to the nature of how they're trading, what improvements can be made in the bond market to make them more efficient and to make them get closer to the ETF?
Yeah, I think to some degree we've sort of partially answered it already. I think the first is a recognition of the stealth nature of NAVs, and I think it's not just us talking on this panel. I think there were a couple of central banks that studied the March-April period, including the Bank of International Settlements with a study on that. I think the portfolio trading is just one way in which the market is finding a solution to a problem. In other words, the buy side are recognizing that handing over a contingent list of bonds gets you probably a better outcome than trying to individually RFQ 100 bonds. And to Dan's point, I think the liquidity providers, be it the big investment banks, who are getting a lot more organized than they have been. I'm thinking of like a handful of banks that maybe left the ETF market a little bit behind in the 2, 3, 5 years ago, and are definitely dedicating a lot more resources. There's a lot more interaction between the ETF desk and the fixed income desk at some of these firms, together with the ELPs that we know very well that have always been very good at that. I think they're going to gel the wheels between secondary market activity in bonds, secondary market activity in ETFs, and the way in which they then dialogue directly with the big issuers to pass that inventory into the primary market. So I think there's going to be a lot of evolution on that. But we're already seeing that. We're already seeing a lot more organization within the big investment banks that we weren't seeing maybe a few years ago. The final point I wanted to make was I think that the demand for data, when we think of these ETF discounts and premiums, is definitely going to be there. So whether it's an obsession over is the ETF trading at a premium or a discount and how is it evolving over time, or whether it's how is the ETF trading compared to CDS, compared to TRS, compared to the underlying cash bonds, I think that is not going to go away. So I think there'll be a lot of solutions in the data space that will help.
And one question that slightly ties this in is the sort of greater fixed electronification taking place in the fixed income space. Is improving technology also a point here? Just to improve the OTC market and improving the bond market, Adriano?
Yeah, and that is definitely happening. There's a lot of evolution that my colleagues in fixed income are part of, and I think that will carry on. I mean, I've just picked portfolio trading because it's been a very noticeable highlight at our end. But the way that, for example, we're working on liquidity scoring of the bond market, and that can either happen at the individual bond, so you drop in a list of ISINs, and a platform can try and help you determine which bonds are going to be difficult to execute, and whether maybe that is better wrapped into a whole portfolio or traded individually, or whether it's even what we're starting to look at, which is liquidity scoring of the ETFs themselves, to try and give institutional and retail clients a sense of whether it's the right time or whether it's the right instrument to trade in a particular size. All of that is coming.
One area I wanted to touch on was the role of authorized participants. It's well documented that they're sort of not required to enter the ETF market and to perform creation redemption. Alan, I know you've done a bit of research on this. Do you think you could talk a little bit about this point and what you saw in March as well?
Yeah, I mean, we saw activity. So there were, we see the discount. So the ETF is trading below this bond basket, at least in these nominal values. And you see that there was significant activity of APs redeeming these shares taking delivery of these bonds and selling them, right? And for the LQD, that was about 10% of outstanding, which is it's quite substantial. So it was working in the direction that you want. The question, I think, that what ties in is like there's two pieces that are why they're not doing more, right? And that's the key question. One answer is, well, because they couldn't trade at these prices, right? That's one answer. And the other answer is, well, because they asked for a much higher risk premium because volatility is high, they're afraid of different things, or they're afraid of being constrained in the future. And that's a very, it might look the same, but these two answers have huge different implications about why, if the ETF price is a true proxy for what the value is going to be in a few days, right? And understanding that is key. I think it's probably both. I think we definitely see when the Fed announces, you see that there is mostly staleness, right? It's very clear that ETF, changes quickly, and then the NAV tags along in a couple of days, right? So it's very clean. You see that the bonds that trade, they are liquid, they immediately tag along the ETF. That doesn't happen going down, right? So I think there is both things happening there, and understanding how much is important. And there's nothing wrong with, the ETFs are doing, their job. The question is, if there's not enough capital there, enough competition, or just the risk environment with VIX, clocking at 80%, might make, this business very, very risky. And that's, I think it remains to be understood. Yeah.
Dan, is there a concern here with the creation redemption process at all with ETFs? Is there anything that regulators need to look at?
Well, I mean, there's no way around the fact that the banks have taken a lesser role than they have in decades past, right? And so ETF market makers now are there in some form, in an oversimplified way to say, to absorb volatility, right? Our balance sheet is effectively the cushion that the market falls on. There's only two possibilities. One is we're very quick about turning over our inventories to provide as much cushion as possible on the way down, which is what we strive for. The other possibility is there has to be more balance sheet. So in the old bank model, there was no turnover. They effectively just have massive amounts of balance sheet. And when the market sold down, the banks collectively provided the floor. Well, there's just a limit to what the market makers can do. Now, there's no secret to the fact that market making and market makers as a whole have evolved. And some of the other APs that I compete with are, massive, and they do have the ability to absorb a lot. But they're also, they're not the same as a bank, which is if they don't want to, they won't, right?
Yeah.
So there is limitation in the system, and that is regulatorily driven, right? We only have so much balance sheet. So, my expectation is it'll be a balance of both. The bond market will be more efficient, and we will be more effective in turning over our balance sheets as fast as possible, which is effectively how we replenish cushion in the fall. But in those moments of absolute crisis, there's a certain limit. There's only so much collective balance sheet from all of the, call it, traditional market makers combined. And so either banks come back to that business, or we all get more efficient at the money that we have. But it's to be seen.
Yeah, good stuff. And just finally, Adriano, as an investor, what would you say the key takeaways are from the March volatility around ETFs?
Well, the Fed was there to step in yet again. So timing-wise, there was some low-hanging fruit there. We generally remain very optimistic on ETFs, and I think Dan raises a good point. Good point around the profile of liquidity has definitely changed. In the 8 years that we've been operational in European ETFs, we've seen big changes in the composition of who provides liquidity. That's a very good point. Having said that, the way we continue to see volumes increase in secondary means there should be increased confidence about ability to trade ETFs generally, unless you're in that pocket. Worth remembering that although data aggregation on the MiFID II is probably not as good as it could be, you can now see the full liquidity spectrum that's available, not just on the order book, but beyond that, and the sizes available. And an optimistic spin would also be that as the market progresses, if you think of Europe being a little bit behind the US, and you look at how the US trades, the secondary market versus primary market ratio in the US is higher. And we'd like to think that in Europe it's inching that way. And that should hopefully mean that unless you're in a really extreme environment, which obviously we had in March, April, there should be more velocity of trading in the secondary market without an over-reliance on that primary market, which we discussed a few minutes ago. So no, we remain very positive. We can see lots of trends in our own activity, new entrants coming in, existing ETF clients that are becoming more and more active, even hedge funds that maybe historically have shunned the ETF market are becoming more and more interested in the ability to trade. So we remain confident about the future.
Great stuff. Well, that's just about all we have time for. Just want to say a massive thank you to our 3 panelists. That's some really interesting insight. We're going to head to a quick 10-minute break. I'm sure Adriano and the team at TradeWeb, they will be in the expo booth. So if you have any questions for them, do head over there. I'll also highlight, we've got a webinar coming up with GHCO. So happening on the 18th of November. I think it's been put in the stage chat on the right-hand side. So do go and check that out. And also Franklin Templeton have written a really interesting piece on our industry corner about an active approach to the bond markets. But yeah, just heading to a break now. Thanks, guys. That was really good.
Thank you.
Thank you.